Hi there, and welcome to our new feature on BNN Bloomberg. We call it Know Your Options. Every 2 weeks on Thursdays at this time, we'll take a dive into the world of options trading, exploring the fundamentals of puts and calls and how you can use them as tools in your portfolio or to manage risk. You can call us, and we encourage you to do so right now at 1-855-326-6266, or you can email us at knowyouroptions@bnnbloomberg.ca. Thom is our expert guest. He'll be with us every 2 weeks to talk about options. He is Chief Executive Officer and Portfolio Manager at Moat Financial. You've seen him before on BNN Bloomberg. You'll see him a little bit more regularly now. He's joining us right here in studio today. And Chris, I want to thank you very much for joining us. This is an exciting project we've got going here, and I can't wait to get started. I'm sure our viewers feel the same.
Yeah, great. Thanks for having me, and look forward to being here a whole bunch.
Options can be complex, so let's keep it simple. The basic two types of options are puts and calls. Explain in simple terms what each of those is.
Yeah, so obviously going to be here more regularly, so we can kind of start from the beginning. So there's two types of options. There's puts and calls. So a call option, where it's different from a stock, is that it's actually a contract between two parties. And so a call option gives the holder or the person who buys it the right, but not the obligation, to buy a set number of shares by a set price or the strike price at a set date. Or expiration date. So they are typically, people who are buying these are bullish, and they want the stock to go up, and perhaps they want it for a bit of leverage. And sellers are often doing it to generate some additional income.
Right. So give us an example. Let's put up shares of, say, Apple, and take a look at what a call on Apple might look like.
Yeah, so Apple right now, we've got the stock trading at about $190. And so let's say you own that stock and you want to generate some additional income. You can sell somebody a June $210 call, so $20 higher than the current share price. Sell them that call option for $5.55. So what does that mean? It means you keep the stock up until that point. You collect that $5.50, or that's about almost 3%, or about 3% a share over the course of that 2 months. And at expiry, if the stock is higher than 210, you can be forced to sell it. If it's below 210, then you just made some additional income for your portfolio. For the person who buys it, they must think it's going at least $5.50 above 210 at some point during the life of the option. So the person who's buying it, pretty bullish, they make the money above 210, and you keep that premium.
Okay. And Chris, at the end of this show, in about half an hour from now, or 20 minutes or so from now, we'll talk about his top current ideas in the options world. That's one of them. He'll revisit Apple and talk about a couple of other stocks from an options point of view as well. Let's talk about puts.
Yeah, so puts, they are the opposite. So where a call gives the holder the right to buy, a put gives the holder or the buyer the right to sell set number of shares by a set date at a strike price. So people who are buying these are often bearish on a stock, so maybe you have a negative bias on a company, or you're buying it for insurance. So this is where the money that options trade for is actually called premium. So some say it's derived from the insurance world, where if you're buying insurance on the product or on the stock, you're buying a premium. So people who are selling these are often looking to enter stocks at a lower price to generate some income. And so we'll definitely be looking at a lot of examples there with the market the way it is right now. I mean, these assets are more prevalent now as volatility has gone higher. This is really a time for options trading to shine.
Okay, what should investors understand about the risk profile, or the risk that may be inherent in options?
So options, they really are a transfer of risk. So take a look at the put side. So the person who is buying the put, they are potentially buying insurance on their stock. And the person who's selling it, now they are getting paid a premium, but they are going to have to buy that stock if it goes down. So if a stock declines dramatically, then there are chances for losses, but you get paid up front. So it really is a risk transfer where one party pays and the other person takes on some risk. Now, it's important to realize if you're buying options, these things do have an expiry date. If you get the direction wrong or the timing wrong or the amplitude wrong on your choice, you can lose all your money. So it's really important to be careful and understand what you're doing. And that's often why we recommend dealing with someone who knows.
And how much of let's say, how much of a retirement portfolio could be devoted to puts and calls options?
So for us, we feel like if you are using this for income generation or you are using it for risk reduction, you could have a low-risk portfolio that utilizes options across the entire thing. It's really, you need to make sure that you're understanding how it works. The thing with the investment business, for the most part, it's not really that creative. You buy low, sell high. You collect dividends, you collect interest. And having options involved in a portfolio allows you to be a little bit creative. Maybe you've got something that has a capital gain and you don't want to sell it, but you think it could go down over the next little while. Perhaps you think something's getting towards the high end of its trading range and you don't want to just sell it, so you can sell a call option. So you can have a lot more flexibility and bring a bit of creativity into an investment portfolio.
That's Chris Thom, and those are his opening thoughts on options. We will take a break, and when we come back, it'll be time for you to put questions to Chris Thom. Here's our number once again, 1-855-326-6266 is the toll-free telephone number. Give us a call. Chris is standing by to take your questions on options. The email address is knowyouroptions@bnnbloomberg.ca.